Good evening, everybody. Hope that you are well, and welcome to the Contenders live stream, the 7th of October, where we are going to be going over Pitchforks Part 2. If you are watching this way into the future, I do recommend you watch Part 1. If you're here for the live stream tonight, then I hope you enjoy, and as always, we will have our questions and answers at the end of the session. Uh, Slightly running a few minutes late here, and that's because we just hit Bitcoin past 10,650. So I was like trying to manage a few trades before starting. So I've got that sorted though, and I am now ready and focused for the stream, as I hope you are. As always, I would say close off the distractions, give your full attention to the stream. That way you can absorb the information a lot better. And should you have the questions, I do recommend you save them to the end, because there is obviously the possibility that as we go along, I answer your question. So yeah, part 2 of 2. This is the final part of the Pitchforks, and we're also covering pitch fans. But yeah, this is the part 2 of 2, and then we're moving on to new topics. So obviously I got to start with the trade disclaimer. This is just a legal sort of information. If you want to read this for 10 seconds, and then we will begin. Well, read it, pause if you need to. Cool. So everyone should know this. So the Contenders live stream tonight. I'm going to start with chart of the week, and I'm debating whether to kind of copy how Mike done his last week and actually do the education first, and then move on to chart of the week, and then we can use the skills in that stream on chart of the week. I'm going to keep it as I always have for this week, but that is something I'm thinking of. You can like leave feedback. Do you think it works better like switching the order around, so this is second and Pitchforks, for instance, would be first? But that's yeah, it's a feedback type of question. But anyway, starting off with chart of the week, where I'm going to be going through Atom BTC. Then I want to finish off the Pitchforks series, and then move on to the questions. Okay, so we are going to start though with Atom, and people are saying that they prefer if I commentate what I'm looking at, and that's absolutely fine. And I do see obviously the helpfulness of commentating. So I'm going to commentate the tools that I'm using, why I'm using them, as we go along. Obviously, starting with a totally blank chart here. Obviously, I do trade Atom quite a lot in terms of when I'm trading altcoins. Atom is a good altcoin to trade. I don't know how many of you can remember. This was probably a good 6 months ago, I want to say, where we was trading Atom up in a channel. It was this channel here, I believe. Would have been the channel when we were trading this back in November 19, and this was a really extremely technical channel on the way up. I remember this one quite well, and then obviously when we got the retracement down, it come back down in a channel. It's quite hard to remember. It was many months ago, but I do remember that we traded this one inside of the Champions Group quite a lot. Just reminiscing. But yeah, Atom is a technical coin. So with that said, obviously haven't really traded it in the last few weeks, so it's fairly fresh to me. So with that said, let's go. So the first thing that I generally do is obviously mark out the levels. This is your daily, weeklies, monthlies, going into like 4-hour charts. And I think what I might do in this section of the video today is focus on more local. So rather than going out and marking monthly levels, I'm going to focus as if we are just focused on what's happening more locally here. So what I'm going to do is just start on the daily time frame. Okay, so I'm going to mark out a daily level, which this is pretty interesting. You see how this would have been your first daily. So I'm going to try and commentate. So this would have been your first daily level. Okay, what you have then done is you've come down for a low. You've then retested that daily level, so the exact daily level, and you've got a rejection, and this has now made a new low. So this is now low, lower high, lower low. So you've entered daily market structure bearishly, although obviously you do have the potential of a more of a range. As you can see, it's come to the low of that range, and 4-hour charts, it's now back above. So you do actually have the overall more of a range going on locally. Reason why I'm mentioning this is because of the fact, off of the rejection off of that daily, it has now just created a new daily. So in this instance, I would remove that last daily. Let's say, for example, the daily candle closed here, and you had your new open. I'd be using the most recent daily level. So that for me is 4989. So 4989. And the next daily that I would mark is this one down here, really. Yeah. I just thought of something I could do is for example, say in advance, I'm going to do Atom chart of the week. And that way people can still try out their charts and make their atom chart of the week charts. And then when I get to it tonight, you would have been prepared, already done your analysis and seen how close it was to mine, I suppose. That's another idea. Anyway, so we have more of, I mean, straight away, I would say it looks as if we're going to be forming a range. So the next thing I'm looking at here is volume. Again, I do think that a lot of people have got really hung up on looking at exo charts, like exo charts, exo charts, exo charts. You have to do remember that you really don't need exo charts, especially in my opinion. As a swing trader, you really don't actually need exo charts. For example, when I'm trading this, I'm not going to be looking at software such as Sierra charts. I'm not going to be looking at exo charts. When I trade my alts, I don't use any order flow software. So when I trade altcoins, you know, I just don't use it. I don't use order flow. So that's because I'm swing trading. The same goes for Bitcoin. If you are swing trading Bitcoin, I mean, yes, obviously you can look at exo, but it's by far a requirement. You can absolutely trade perfectly. Like, you don't need exo charts. It's just an optional extra, but you absolutely don't need it. And I wouldn't even refer to it when looking at these alts. What we were looking at here on just a simple inbuilt trading view volume profile, okay, is we got the obviously the more or less declining volume. So we are seeing this big decline in price, but also volume is got a bit of a peak here, but it's nothing major, is it? Like, this is a spike in volume, this is a spike in volume, but this is this is nothing. So we got basically declining volume as we are still going sideways in this along, you know, as we're going along. The next thing that I'd be interested in is, although I'm only trading this locally, I would still want to know overall from the inception to where we are now, where the point of control lies. Okay, so the point of control is untapped. So the next thing I'll be doing here is marking out, as I don't like to keep everything on my charts. And obviously, doing this properly, we do want to put this into folders. This only takes a second, and it's very helpful. So hide term time frame levels. Hide that for a second, and then we're marking on our volume. So this goes inside of the volume folder. And we got our label this point of control. I'm going to put this one on the value area high. And I'm going to put this one on the value area value area low. Excuse me. Okay, so we can now remove the fixed range. We can put this into the volume. Now, what we are starting to see is we have a smaller term daily range going on here, which is more of a local daily range. But that is actually encompassed, sort of like taken over by the volume, the volume range that we're presented with a really, really, really nice one. We look at this low, which has given us as our overall low. And really from this, what we can see is, okay, low, support, bit of a resistance tap on the point of control, back test the value area low, break, retest point of control, resistance of the value area high, broke above that before losing it, retesting, coming down to, I have done analysis on this, so I already know what this is bounced off of. I'll show you a bit later, but we can say, because we haven't done the analysis yet, this is no man's land. Who knows why this is bounced at the moment? We moved up, and well, that's when we now get to our daily range, isn't it? So that's kind of what we have on terms of the volume. So that's the second thing I'd mark out. And again, once I've marked out the levels, we can remove it temporarily. We don't need it blocking up our screen. We'll move on to the next step of the analysis here, which for me is going to be a pull. I'm specifically not going to use pitch fans or pitchforks during this analysis because I want to do that at the end. So my plan is to do the analysis not using pitchfork or pitch fan, and then at the end show how this analysis can be 100% improved with the tools that I've taught at the end of the lesson. I think it'll work well. So I don't want to use the pitchfork and I don't want to use the pitch fan for now, but I can use obviously the Fibonacci speed fan, and there is obviously a difference between the pitchfork and the pitch fan and the Fibonacci speed fan. They are three totally different tools, although similar. So what we can see here from our last high to low, coming down into somewhat of a range, as we can see here, a little bit of resistance broken that level, you actually go straight through the 0.5 here, 0.382, sorry, 382, up to retesting the 382, coming up to around the 0.5. And then again, you're coming down to a little bit of no man's land. We can't say why it's bouncing yet because we haven't got to looking at this. Okay. So I like the pitchforks on a higher term time frame. I really, I think you're starting to see this more and more. It's a tool that's extremely underrated. Like, not many people really use the Fibonacci speed fan. Even in the group, you don't really see much people giving it much love. But this is a tool that I'll use on every single analysis because I find it really helpful, because it's not a compassing, you know, it's not, why do I keep saying it's not covering a horizontal, but it's actually covering time, which is really obviously, yeah, it's great. So that is this. So this is obviously a, I'd rename this as resistance fan, because this is obviously going to be our more looking at for resistance, and then you're going to have a support fan in the flip side. But looking at this, it might not be so relevant anymore. Let's check it out. As you can see, up to the highs. We just remove our resistance one a second, and we can zoom. Sometimes what I'll do is put it on the chart, and if I don't feel it's relevant anymore, I'll just delete it. So I can say that, you know, when you look at this in this section, it definitely was relevant at this point in time. And obviously this is the thing, and this is the same with pitchforks, that you go back in the chart and see their relevance to know whether you're actually looking at a relevant tool or not. We can see that this was definitely relevant when it was first, you know, before it really come to it being even a fan. When we come back into the future, or no, back into where we are now, we can see that you got a certain amount of resistance off the exact line, back into a bit of support. For me, it's not really what I would call relevant anymore. Okay, you've broken down from the 7.5. Yes, it does seem to have come back in play, but it's not enough that I would say I could base a trade off of that. For me, is not. I couldn't base a trade off of that because it's been broken through too many times. If I'm going to trade off of a level like this, then I like to see this absolutely still being respected. You know, because not every pool that you're going to do has obviously got that total respect. The other one that you could be interested in, on the Fibonacci side of things, high, low, high. So this all come to the 1-to-1. So that's been a pretty good SR level. And what I would also see is from this high to the low. Okay, so you come into the CC here. So really a 1-to-1 to CC range, and this is going on bigger term time frames. But then what you do next is you add on your Fibonacci channel, high, the low here. And if you look at this then, so we're starting to get somewhere now. We have the CC resistance, and then we have the middle of our Fibonacci channel as support. And this is what we mean by really great support. So this is clearly what I would call a very relevant channel. Okay, midpoint really well respected on the last bounce, and there was confluence on this one. But what we can see is, again, ultimately we're just building more and more of a conclusion here, and the conclusion is it's going to be remaining range bound. There's no opportunity that's standing out in front of us. Obviously we can do a few more tools, but I generally wouldn't be wasting so much time on higher term time frame analysis, because I'm fairly, you know, you can fairly safely bet that this is locally in the daily downtrend, but it looks as if it's now kind of taken the lows coming down to the 0.5. It's now reclaimed the last low of what was your daily channel. And ultimately, let's be honest, it looks as if it's going to remain range bound. So if we then come down to a 1 hour time frame, fairly certain you remain range bound on this. Let's just stay on the 4 hour. What you would start to do is, you know, let's summarize it slightly. We've started with some high term time frame analysis. You know, I could spend another half an hour on it, but I don't really feel the need to do that tonight. But what we've basically summarized, all the other tools that I could use, I'm going to come to the same conclusion basically. So it feels as if it's a bit of a waste of time. That we're range bound locally, and if we're range bound locally, then how do we determine the next best trade? So what I would be looking at here is grabbing my indicator of the fixed range and look at more locally. The question that I get received actually quite a lot is, how do I determine where this local range is? And it's actually just like visually looking. So if I just remove that for you a second, why do I pull my fixed range from here? Because, you know, let's be honest, for me, it just feels so natural. And I'm sure as you're using the tool more and more and more, it becomes more and more and more natural. But you might have people pulling from here. You might have people pulling from here. You might have people pulling from here. We might have people pulling from here. Oh, if I can do this, you might have people pulling from here. No, the only one that I'd be doing for what I would consider a range is literally from this last low. Okay. And for me, this comes really natural. It's like I don't even think about it, sort of thing. I'm really sorry. I got the cough again. Yeah, for me, it just feels natural. But you can also, I feel as if I can explain it. This is obviously your last real low where you put in what visualizes to you as more of a sideways range, doesn't it? Where there's your range, there's your deviation, there's coming back up to the highs. So you can see how this is essentially the range that we're trading. So fixed range is the range that we're looking for. And really nice. What we can start to see is we have more of a local range then coming in, don't we? So we have the value area high of the local range, we have the value area low of the local range, and then we obviously have the point of control of the local range here. So what I would do, this is when it's easier on exo charts. But what I would do is try and determine how much of the time has been spent near the high of the channel and how much has been spent at the low. Obviously, this is a lot harder when you're doing this off of trading view, because on exo it's automatic. But I can say, yeah, it's a little bit more difficult. We spent the first attempt on the 11 days up at those highs, but then the next period of the lows was 13 days. And back within the range, we've spent 9 days. Basically, what you're doing with this to try and determine is the time aspect following the price aspect. So is volume lining up with price? It's obviously where you use TPO charts, and the TPO's chart series is starting extremely soon. But what we're trying to determine is volume following price. So we've spent a relatively long time at the highs. Obviously, we come back down to the lows, but when you could retest it here, you retest it here. And obviously that, I believe, was on those spikes. So you saw a little bit of spiking up near the highs. So obviously what I'm saying here is the point of control is really close to the high. And so if the point of control is really close to the high, but you've spent the majority of your time at the lows, it's obviously different than if you actually did spend your majority of the time at the high. But what we can say here is, I can't say absolutely accurately, but it looks as if we've spent a lot of time at the highs overall on this part of the range. Yes, we obviously got the move down, but when you do look at the volume was very low at the lows, and your spikes, okay, are generally at this section of the chart where we started the range from. Got a spike here, which is coming into the high. So yeah, this is obviously considered a little bit more bearish. That's why I'm trying to highlight this more, because this is considered a little bit more bearish. If you've got a sideways range, but your point of control is up the high of that range, shows you that you got a lot of trap traders essentially, isn't it? So you don't need exo charts to work this out. What we can see is if the point of control is up at the top of the range, then you have lots of trap traders locally in this range. Something that I would bear in mind, because on top of this, you have now put obviously in this bearish market structure. So then you have to try and determine, I suppose, is this a long trade that you still want to take to trade the range? If we are looking to trade the range, then your invalidation is already sorted for you. There's no need to try and outsmart it on this one. And you got your target. So what we're looking at here is a 2-to-1 risk to reward ratio. What we have going on here a bit locally is you've put in your low, high, higher low, higher high, potential higher low. So, I mean, slightly conflicting signs, but I think ultimately we have more to work off of here, as if the chart's going to push to the upside. I would say so. Okay, so we have slightly run the CC here. You can see there's a slight front run of the CC. So this is considered bullish. If you front run it by this much, this is front run by a good 1%. That's quite a front run. So you front run the CC by 1%. You have taken out the lows. You've reclaimed lows. I would absolutely say that this is an acceptable trade. you know, a trade that I'd be sort of willing to take, because of the fact we've done some high time frame analysis. We've worked out, okay, it's more likely to remain range bound. We've then come onto the charts more locally, and I still feel as if it's more likely to remain range bound with front run to CC. With, you know, it's not an official swing failure pattern per se, but we have taken the lows nevertheless, and we've reclaimed. And you can see off the last 15-minute candle, you've back tested now that value area low. So you have reclaimed a value area low. So if you're viewing this from a standard perspective, and you might even have a CCV. So the people are asking, how do you do CCV setups if you only have trading view? Well, let's explain how you do that. So we're looking at the daily close. Okay, so this isn't okay. So you would have opened your day here, and then what we're going to be looking at is our previous day. So we'll take this back up to previous day, which is going to be at 1 a.m. Okay, so yeah, you see this? So there would have been your value area low of the previous day. So much more confusing, isn't it, doing it without exo charts? It just does it for you. This would have been your previous day value area low. That would have been your previous day point of control. That would have been your previous day value area high. And you've opened the day here. So obviously you have 80% probabilities, if you get acceptance back into here, that you trade it back up to here. Okay, so you can kind of define this a little bit better, I would say. You're starting off with a 12% reward for a 6% risk. I feel as if I can define my risk and reward better than this. I don't want such a high target, but I also want to decrease this. I want to go from a 6% stop loss to a smaller stop loss. I feel as if I can do it, I can look to take the long with strength, coming back into, which was previous day value area low rejection, bouncing off the range point of control. I've got a new invalidation, which is actually just 2 higher lows back, and I've got a new target going on here. Okay, so this gives me the risk to reward is obviously 1.5. You know, you will get traders, and I know I've preached it myself, don't take a trade unless it's 2-for-1 risk to reward ratio. I will take trades that are less than 2-to-1 risk to reward ratio if, for example, I'm playing with a trade that's got 80% probabilities to work. You know, that's what you're going off of. We're going off of an 80% probability of a trade. We're not going off of, oh, it's a 2-to-1, I can't take it sort of thing. But that's the way I'd view it. You know, if you want to be really tight, then obviously what you could say is if this ranges again here and it breaks it, well, then you have it. You could essentially go for a smaller stop loss, because of the fact then you would have broken up with a bit more bullish market structure. Stop could be here or here, because you're then back into the 80% probability of a CCV setup, aren't you? Yeah, let's be honest, you are. So that's what I'd be looking at. Might get this during the stream. What we can do, add an alert. Obviously, you would want to see a little bit of volume increase upon getting back into here. You know, this is just extra. Okay, so I'd say the OBV looks absolutely awful. The OBV looks extremely bearish. That's the first thing I'd note. The OBV is bearish. But nevertheless, we can still accept the trade. So I'm going to end the analysis here on Atom, and we can see by the time we get to this in 20 or so minutes of what's going on, like a continuation of the trade sort of thing. That's enough speaking for now, and let's go over to the Pitchforks then. Just going to take a drink. I've been taking some classes. Obviously, I had a really bad throat. I need to remember to keep my posture, because apparently the posture is a really big thing. So, excuse me. I do hope that I can move this up a little bit and it doesn't get in the way too much. So, need to try and speak and keep the posture. So, Pitchforks, part 2 of 2. Pitchforks, part 2 of 2. Obviously, Mike covered part 1 last week, and this is a expanding upon Mike's, which I thought was really good. He explained how to use the pitchfork. So we're going to be covering tonight the Pitchfork part 2, a little bit more what you can be looking for inside of it. Oops, didn't try and click that. And then moving on to the pitch fan, which is a tool the pitch fan is a mixture of the Fibonacci speed fan, which you know I absolutely love, and the pitchfork. So it's like it's taking one of my favorite tools, period, the Fibonacci speed fan, and it's combining that with the Pitchfork, which is a really, really good tool as well. And it's giving you the pitch fan. So it's like combining two amazing tools and just giving you an all-in-one brilliant tool. So I'm pretty happy to give you the pitch fan. And also it's very hard to find any information about a pitch fan. So first thing, starting off with the Pitchforks. So if the midpoint of a pitchfork offers no resistance, you trade this to the outer line. I have countless examples for you today. So any questions, save them to the end because I probably will explain it. So pitchfork, if the midpoint offers no resistance, you trade it to the outer line. Again, I've got examples coming up. Fibonacci pitchforks are for high term time frame analysis. Yes, there is a Fibonacci pitchfork. I will share the fibs that you want to use off of this. We'll get to it. And the last point here is the pitch fan is for time analysis. So this is obviously your mixture of the pitchfork and the pitch fan offers Fibonacci speed fan. You know, that's how you get your higher term time frame analysis, but they are two totally different tools. The theory is the same, if you understand. So the first point I'm going to be basically explaining here is if the midpoint offers no support / resistance, trade to the outer line. So you see here, this is an example on Bitcoin. And you can see how you have done your original high, low, and high here. And you come down to the midpoint. So when you're originally taking the trade, let's say that this was based off of a high today. Let's say we took a short here. We would originally always be looking for the midpoint as our take profit. At least take profit one, if not close out the whole trade. And obviously, if you do only want to take profit one, your top take profit two is obviously the outer channel. That was covered by Mike. But what we're looking at here is the relevant or the reaction off of the midpoint of that channel. If you get a strong support bounce off the midpoint, you're going to close out that trade totally, because that is a very important support level. This is going a little bit into Elliott wave theory, but if you're viewing this as your wave one, this is your wave two, the wave three has to be impulsive. So Elliott waves and pitchforks obviously coincide pretty amazing. But this is your wave one, this is your wave two, and if this is a wave three, it has to be impulsive through the midpoint, which then gives you your overall target for the lower of the pitchfork. But if you actually get a bounce off the midpoint of the pitchfork, then what you're going to be doing is, originally, instead of thinking this is a 1, 2, 3, you're going to start thinking to yourself, okay, this is actually an A, B, C, because you find support of the midpoint of the pitchfork. You know, Elliott wave analysis aside, essentially, to make it really simple, it's just because I link it to Elliott waves, but really simply, it's if the middle of the pitchfork offers support, close the position and actually look for longs. And if the middle of the pitchfork offers, well, zero support, even flips into resistance, keep it as your take profit one and aim for the bottom of the pitchfork. So the reaction basically of the middle of the pitchfork is absolutely key. Again, if you're trading on a high time frame chart, let's say your pitchfork is from a 1 week chart. If you close a 4-hour candle through that's not, doesn't matter to you. You're looking for the higher term. You want to see like a higher term time frame close through the pitchfork to say that it's the level claimed or lost. Okay, so if you're trading a weekly chart, you want to see at least a weekly close sort of through the level. Or if you're trading off of a daily chart, then you might say to yourself, okay, I want to see consecutive daily closes through this level. You know, if you're trading from a daily chart, you're generally keeping these positions open a few weeks to a month. So you're not going to just suddenly close out your trade if for example this candle had closed down on the daily and you're like, oh, we've got a daily close through, I need to close out this position. No, you're going to wait, or generally try and give yourself some sort of barrier saying, okay, let's wait for consecutive closes through the level. Don't jump into something straight away. You can use consecutive closes as a filter, you can use volume as a filter, open interest as a filter, some other filters that I might give myself is like a swing failure pattern filter. So there's several ones you can apply, but you just don't want to get out too early. I think like what I'm noticing, I'm trying to like pick up on things of how I can improve off of like not feedback, but what I read in the chat. And I feel like there are a lot of people that get out of their positions too early and then they're like, oh, damn it, I closed too early this trade. I should have kept it open. And I think like this is something that I can do streams on of like how to avoid getting out too early, and like adding filters is obviously good. Anyway, off topic. The mid of the pitchfork offers no support. Keep trade going to the outer line. And obviously if this was a looking for a flip trade and we were going from high, low, high, the middle of the pitchforks offers no resistance, trade it to the outer line. You know, that's pretty self-explanatory, I think. Okay, so another, you recognize this one? This was Bitcoin yesterday. What a trade. This is a pitchfork from low to high to low. One of the things that I'm always going to be doing, if I'm using a pitchfork, I will always be looking, was this relevant in the past? Yes or no? If the pitchfork was relevant in the past, it makes the pitchfork like times 10 more powerful. Like it just is so much better. If I had added on 0.1, 0.2, 0.3, and let's say the midpoint was going along here, and it was like a totally irrelevant level in the past, then I can be like, right, okay, it still gives me a target, but if I can see it with something like this, then it's like, oh wow, this is actually amazing, because the middle of the pitchfork is resistance, support, 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 support. If I can see that it's acted like that in the past, well, that's exactly what I'm expecting in the future. And so this gives you an extremely powerful pitchfork, because it's been a prior level without even sort of knowing about it, because you wouldn't have had this you wouldn't have had pivot 3 before it formed. But then you also have the confluence of this being a trend line itself. So it just gives really powerful. But, you know, once again, if the middle of the pitchfork offers great resistance, like this clearly has, I mean, let's be honest, you hit it once, rejection, you hit it twice, you get rejected, you hit it 3 times, you get rejected. You know, at this point in time, you've got to be thinking to yourself, okay, great, I took the longs down here. You're going to be closing out at this level. And again, confluence. It's not just thinking I'm only using the pitchfork, because let's be honest, I'm never, ever, ever, ever going to take a trade off of just the pitchfork. When we start combining our ideas, as you know, I've said this one a lot, but when we had that, this was yesterday's charts. When we were up at that high yesterday, we obviously had this pitchfork at the top of had the top of our triangle, and the butterfly harmonic. I had the naked point of control. We had the monthly open. Yeah, I think that was about it. So you obviously had confluence up at these highs. You know, you had like 4 or 5 different reasons of why this was going to reverse. So the pitchfork is just obviously another level of, we're like, oh wow, we're seeing 5 different things here. Let's go short, sort of thing. Or at least saying, okay, let's close the long. Let's not get greedy anymore, because, you know, obviously it can still go to the upside, but we've seen a reason to close, so let's close. And as you know, that's exactly what I done. The long from 10,470, I did close out at the high, and I did go short, and we did drop down in the end to 10,500. So yeah, but the pitchfork was obviously very helpful in that. So what we can see here is, once again, a impulse, retracement impulse. So we got our 3 pivots. Middle of the pitchfork, once again, offers little support. So what we're doing, trade it down to the low. And this becomes very relevant, that also we can see going forwards how we have gone high, low, high. Why I love this example so much: high, low, high into the CC, coming down through the midpoint, offering really no support, bouncing off the low of the pitchfork, coming up to the midpoint here. And this is where we're going to have to be using some other tools. Does this have the strength to come back up to the heights? Because generally speaking, what we are going to be expecting, okay, if we're only trading off the pitchfork, and as we said, we don't just do this, but if you have seen that, then you would be expecting the bounce up to here. Obviously, only reaching here is a sign of weakness. So what do? Sign of weakness on the pitchfork. Ding, ding, ding. It has not reached the high of the channel. We have now broken back below the low, traded back down to the lows. Once again, absolute pinpoint before pinpoint coming up to the middle of the channel. See how perfect that is? Channel, pitchfork, whatever you want to call it. You come off the midpoint absolutely perfectly. Rejection, back above, and then you're grinding along that for so long indeed. I've had a question about this one, because this is one that I posted in the Champions group a few days ago, I think. And the question is this a bearish chart? So you have to think to yourself, is this a bearish chart? I guess I'll give you a second to think about this. Do you think this is a live chart? This is exactly what it looks like now. Do you think this is a bearish chart? Yes or no? I think it gets you thinking a little bit, because look at this. Look at the reaction off of the low. If that's not impulsive, then I don't know what is. But so for the answer, I would say this is bearish. Okay, I'd say it's bearish. Also, I'm a trader that really likes to look at fractals. So history doesn't repeat exactly, but history does rhyme. So we like to see what's happened at the end of the day, we get technical analysis by recording statistics of what's happened in the past and saying what's the probabilities that it happens again. And so if you look back here, really big impulsive reaction off of the low, putting in a low, putting in a lower high, coming all the way down. Look at this. Impulse, put in a low, put in a high. You know, this is so similar to this. Even with the way that you bounce off the middle, you go through it, you get back above, you retest the medium line. Impulse, you come back off it, you go through it, you retest the medium line, you put in the lower high, you put in the lower high. The structure is absolutely just very, very similar. But making it not to do with the fractal, why would I say this is still bearish? Well, you're still within the downtrend channel Pitchfork. So how does this get really bullish? From Pitchfork analysis, it has to break the outer line here. And then you would say, right, we've broken the downtrend of the Pitchfork. It's bullish. Okay. So this is now moving on to Fibonacci Pitchforks. And I'll give you all the Fibonacci levels towards the end. So, yeah, this is your Fibonacci Pitchfork. The theory is exactly the same. So if you need a reminder on the theory of these, then check Mike's video last week. He covered the theory. But yeah, this is a Fibonacci Pitchfork, and different situations for different use. The standard Pitchfork, medium line, two outer lines, it's as simple as it gets. Let's be honest, it's as simple as it gets. And you could say that this is best. I would not use a Fibonacci Pitchfork on a really low term time frame. But if we're looking at high term time frame analysis, obviously from here to the high, you're looking at almost $5,000. It's like way too big. You're going to be spending so much time in between. It's way too big, isn't it? What we do is we add a Fibonacci Pitchfork, and from within here we got our 786, 618, 0.5, 382, and the 2.5, because this also uses, like, you can also use on the Pitchforks 2.5, 5, 7.5, 1.25. So this is like a little bit of GAN as well, but nevertheless, you can see we got some more examples coming up. But yeah, the Fibonacci Pitchfork is good for high term time frame analysis, because literally it's a bit pointless using it $5,000 move. Like, it's never going to be, it's going to just not good. So you add in the Fibonacci levels, and they give you, as you can see here, again, this is a nice example. Have a guess where you rejected from. As you know when we were hitting 12,500, you'll know that I gave 12,500 as a resistance, among many others, obviously, but 12,500 was a level. But you can see here how that was also the 618 of the Pitchfork. So, yeah, Pitchforks are great. You can also see how the medium line has been resistance, 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 back into support. So without a doubt, okay, this is a big if, if we break to the downside, we can expect this to be a major level of support. And that's obviously around 9,200. If we break to the upside once again, you still got to contend with this 618, which is around 12,400-ish region. Okay. This is, looking at the 618 of the Pitchfork. And then so this is the same Pitchfork, this one, zoomed in. And you can see here, or when you zoom into the Pitchfork, the midpoint is obviously very relevant, and as well as the fib levels that you get off of this. You can use these again for trades on its own. You could use these as take profit entries. You can see 618 down to what would be the 382. Really, really, really precise, pretty precise. So you go through the 0.5 here, you come down to the 2.5. Again, it's not overly, let's be honest, this wouldn't have helped you because this was too much through the level. But when you do come back up, you do get the exact touch of that 382. Come back down to the 2.5. You come back down to the 2.5 once again with, pretty nice precision. So you basically just look at the Fibonacci pitchfork as offers you good trades for these take profit and entry levels, or at the end of the day, another level of confluence. You know, that's what it is. It's another level of confluence, because I wouldn't trade off of this alone. So yeah, this is another example of Bitcoin. So this is obviously your lows back in 2018, coming up to your first high, coming down to obviously the low where you got that really big breakout to the upside. But as you know, from high, well, you might not know this, from the low to the high to the low, putting a pitchfork on this, look at the midpoint. Resistance, but where it's coming down to, the 618, back to the midpoint, comes down to the 75, back to the midpoint, breaks the midpoint, back test the midpoint, where it doubled in price, over doubled in price. So just another great example of a pitchfork on a higher term time frame, with obviously your Fibonacci lines. And the last example I believe I have here is it's amazing. The overall, where Bitcoin first become its lowest points back in 2011. Okay, from 2011, and again, this is a little bit of Elliott wave theory here. Oops. This is a little bit of Elliott wave theory, but this is your wave 1 impulse, you could say. This is your wave 2, and this is your wave 3. Why is it wave 3? Because you found no resistance at the middle of the pitchfork. You backtest it and you get a secondary impulse. Just amazing. The exact high of Bitcoin was the 1.618 Fibonacci extension of the pitchfork. Like, that's so cool. That's really, really amazing. Low of the pitch, so your low, high, low, and then if you incorporate Elliott wave, like really basic, everyone knows 1, 2, 3, 4, 5. 1, 2, 3, 4. Look at the midpoint, support of the midpoint, support of the midpoint, support of the midpoint, support of the midpoint, and this is what's happening right now. You are still finding support for that midpoint. That is a pitchfork created from 2011. That's so amazing. If you love technical analysis like me, which I'm sure you all do, that this is so amazing. And the way they times the high on the 1.618 extension, I mean, straight away, if you struggle with Elliott waves, then like, how easy is this making it for you? Wave 1, wave 2, wave 3, we're in wave 4. Yeah, I think it's really good. And oh yeah, this is the zoomed in. Sorry, this is the zoomed in here. Look at the respect of the midpoint. Midpoint touch, midpoint touch, midpoint touch before the really big breakdown, 618 Fibonacci level. That's from the midpoint straight to the 618 Fibonacci level, where obviously you bounced around that 4,000, back up to the midpoint, exactly, rejection, really strong rejection, back to the midpoint, exactly, rejection. You come back through and you spend time around it, and now you're in a bit of no man's land, aren't you? But look at, just look, I mean, it's incredible. It really, really is. Yeah, so now we're moving on to the pitch fans. So we now see the pitch fans here. So the difference, I guess I'll start off with the pitch fan versus the Fibonacci speed fan. Really simply, if this was a Fibonacci speed fan, we'd go high to low, and that's it. You pull from high to low, and then you get the resistance in terms of time, just from a high to low. Whereas this is more trend following. So with, you know, it's a little bit Elliott wave theory, but you obviously got your high, low, and then your lower high. So the pitch fan is using the pitchfork analysis where you go high, low, high, rather than just 2 points. But you're looking at this in terms of a trend. So you go high, low, high, and then the theory is the same as the Fibonacci speed fan. So if you need a reminder on that, just go back and watch the video on speed fans. But the theory is the same as the speed fan. You still got your fib levels, your 0.25s. Yeah, it's pretty self-explanatory. You can see here how you get support and resistance off of these lines. Really nice 0.5. Another 0.5 coming up in the end. So this is the 1.25. And then obviously your 1.618 sits at 15,000. So yeah, this is the pitch fan. So it's basically a combination of the speed fan and the pitchfork, essentially. Again, taken from low, high to the low. And again, this is back from a major low, 2011, high to the low. As you can see here, price grinds along the lower line before coming up to around the 0.5. But the magic again is where it bounced off of here. So as you know, that was the 0.618, and here it's the 1.618 extension. So you can see that this move up on the pitch fan was actually fairly weak. You only made it up to the 0.5. But where it found support was off of the 1.618 extension from 2011 to around 2013 to obviously the bear market ending in around 2015. It bounced off the 1.618 extension of that. Okay. Now this is where it gets really cool, that you then use these tools in confluence with each other. So this is a pitchfork here, low, high, low, used together with the pitch fan, high, low, high. And then what you can see is this obviously pitchfork is giving you your target, the midpoint. But then on top of the midpoint, you also have the 0.25 Fibonacci, it is a Fibonacci one, I suppose. But the pitch fan coming in with confluence. So you get the target of the pitchfork off of the resistance of the pitch fan. You know, that's a really strong level when you get two of those together, because you're getting, well, they're just good, really. What's the word I'm looking for? Like, there's like geometric kind of analysis where you're seeing it in time and price coming together. Yeah, it's pretty powerful. And I'm going to go over now to the atom chart. I'm going to go to the atom chart, and I'm going to show you how we would use the pitchfork and the pitch fan to get to do this. Actually, I think I will one more slide to show you. Okay, so this was, yeah, using it in confluence. So from high to low to the high, we know we come into the CC, and then we know obviously that this was also high, low, high, the 1-to-1 extension on top of the middle of the pitchfork. Just simply amazing. You get the bounce back of the outer warning line, and you know, yeah, just a good example of using it together with other Fibber tools. And yeah, this was the final slide now, and then I'll go over to Atom. But to really force it home, this is a tool, obviously the pitchfork and the pitch fans, that can look at time, price, targets, and stop loss. So you could have a strategy that only uses these tools, period. Like, you could use this alone if you want to, because it incorporates everything that you need: the time, the price, the targets, and the stop loss. And that's obviously powerful. Very, very powerful tool, because you're getting everything that you need. You're getting entries, which is obviously your perfect entry of a pitchfork at the CC. You're getting targets. You're getting invalidations, which is obviously would be above the high when it first begins. You see how this is giving you a very powerful, very, very powerful tool. So I want to go back over to Atom a second. So if we zoom in on Atom, it hasn't got our entry trigger. That's a shame. I was hoping over those 40 minutes we might have got something. But what can we do? Didn't give me anything. What I can do though is hide all this, and this is why you use folders. That is why you use folders. So we got the daily time frame here. I guess it's really hard for me to look at the answers of this, but just in your head, don't bother writing it. But in your head, where would you pull the pitchfork and the pitch fan here from? We're doing high term time frame analysis. Where are you pulling your pitchfork and your pitch fan from? Think of this for a second, and then imagine it, and then I'll tell you where I'd pull from. I will start with the pitch fan. So really simply, we are in a downtrend with our high, low, lower high, and then obviously a bit of a more of a local uptrend. But overall, it's really clear we got our our high, our low, and our lower high at this point. Okay, and so what we can see here is the way that we're coming down on the riding along the 618. You know, you can't really lose it. It comes for its bounce up, and in the end rejects off around a 1.618. Okay, so this is giving us a high, what I would refer to as the high term time frame pitch fan. So then where would our high term time frame pitchfork be? Okay, it's obviously going to be looking at this in terms of its low. So the same low as you took with the pitch fan, to the high, to the next low. Okay, and then you obviously have, if you're looking at this in terms of Elliott waves, then I would say that this, instead of looking at this as a 1, 2, 3, impulsive 3. So this is an ABC because you've rejected at the midpoint. We need to make sure this is lined up exactly. Rejected at the midpoint, isn't it? So that's a little tip. We get to Elliott waves soon, but that's a tip of Elliott waves. So if you reject at the midpoint like you have, you try to get through it, you reject, you backtest, you get a move to the downside. What are you saying to yourself? We've rejected off the midpoint. I no longer think that this is a 1, 2, 3. I no longer think we're going 1, 2, 3 because we rejected at the midpoint, 4 and 5. I don't think that's the case anymore. What I think is this is actually an A, B, C, and we're coming back down. So what am I saying to myself? We have rejected from the midpoint. So what am I expecting? I'm expecting price to come back to the warning line. The outer warning line. These are called like your warning lines officially. Because there's your outer warning line for a bullish breakout. This is your lower warning line for a bearish breakout. But nevertheless, what are you thinking to yourself? We have rejected the midpoint. I'm no longer bullish on this. What am I expecting next? I'm obviously expecting a rejection and a move to the outer warning line. Want to see this? You can just hide this a second. Come to the 4-hour chart. There you go. There's the pitchfork. Standard pitchfork. Let's just do it on the daily still. Standard pitchfork. Comes straight to the warning line and got a bounce of 37%. So I mean that's just amazing. It really it is amazing. Low, high, low. Coming into the midpoint rejection, come all the way back to the outer line, 37% to the 38% bounce to the upside. You gotta admit that is amazing. Obviously, you have this on top, and you do need to be careful that you actually put this on the right high. Okay, so you can see like your confluence of the resistance that you had around it. Obviously, this is no longer so relevant. But yeah, nevertheless, you had the 1.618. You saw the middle of the pitchfork, and yeah, the way that you bounced off the lower the pitchfork there. That's pretty cool. So like standard pitchfork theory, which you now know. So we will move back to this. I hope that I've shown you how good of a tool it is. Yeah, so this is the next champion stream. What I want to do in the champion stream is I want to start, because I feel as if I'm teaching a lot of theory, but I want to start again. Obviously, I've done this, in the past, but I want to once again create a new live trading account and use this account for swing trades. Because the problem is, what I've done in the past is trying to scalp on stream, but on the Sunday we never get the volatility. It's like I do a live stream and the Bitcoin goes to sleep. But what I'm going to do is create a new Bitcoin account, put on a few Bitcoin on it, and use this for swing trades only. So then I'm guaranteed to take a trade every Sunday, and you can see the exact processes that I'm going through before I take the trade. So I think that this is going to be an extremely valuable new thing that I'm going to be adding. You can see me taking the trades on the swing traders perspective. So that's what I'm going to be doing in the champion stream. So I'm pretty excited for that, because I feel it's just going to help so many people. And so yeah, questions. If you have any questions, shoot them at me and we'll go over them. Cool, we've already got some in. So let's download these and we can begin. Oh, we got a lot of questions. NASA. Isn't it harder to check the time of the range on Exo charts than on TradingView? No, I'm referring to TPO. So I haven't covered TPO charts, I know, yet, but we're going to be doing that, and yeah, it does it all for you. So it's a lot easier on Exo charts because it just does it for you. So that's TPO theory. Frederick Huber. What is your thinking for not marking monthly, weekly levels on Atom chart a week? Are they not relevant? Yes, they absolutely are. And there was a reason why I wanted to not mark the weeklies. And it's because it was actually so perfect. Look at this. I always do that. I delete everything. We'll go on to the weekly. And this is why I kind of didn't want to mark it at first, because it was just like, it just is too perfect. I was not going to show you all, but because you asked. Look at this. There's your highest weekly. That's why you rejected. That's why you rejected. Let's be honest. We come down to the 1 hour chart. I mean, it's just insane. This is why this is why at the end of the day you do mark these higher term time frame levels. Look at it. What did you have on top of this? You swing failure pattern the high onto the biggest weekly on the chart. I mean that's why you reject from there. You know, I just think that's absolutely outstanding. So yeah, the answer to your question here is, do you still mark out these levels? Absolutely yes. I just didn't actually want to mark the weekly and the monthly because I knew how perfect it was, and yeah. But yeah, to be honest, yeah, I would always mark theirs out normally. I just didn't kind of want to just because I knew that one was really good. Anyway, I've shown you now. So, does the CCV setup still work? Yes, absolutely, 100%. Yes, the theory is exactly the same across stocks, commodities, Forex, cryptocurrency, everything. Yeah. So yeah, you'd be looking at this across. The theory is the theory is the same across all of the markets. All of the markets. JH, do you use the original Pitchfork when you gauge reaction of the medium line? Yes. So the main difference between the original and the shift is obviously the shift is more of a range. So if you're necessarily expecting a range, then you're going to be using the shift. Okay. Whereas if you're expecting an impulse, then obviously you're going to be looking at the original, because the original is generally from Elliott wave. One, there you got your 1, 2, third is impulsive. Whereas if you're in a sideways piece where you might only be expecting a WXY, well, then you're going to be drawn towards a shift pitchfork because you are in a range. So that's the biggest difference. Shift, modified shift, they're exactly the same. They're expected for ranges, whereas the original is expected for impulses. The majority of the time, you're going to expect an impulse. Tom Jones, do you use pitchforks to find harmonics? Looking at your examples, look like there could be confluence from pitchforks, high lows, middle to find harmonics. Absolutely yes. The answer is yes. So these are good tools that you can use to find, without even looking for it on purpose sort of thing, you do find the harmonics. Yeah. Because for example, you get that move up, you come down to the CC, and let's say your medium line's at the next CC. Well, then what do you have? You have a harmonic, don't you? So you have your low, high, higher, low, which gives you your ABC. You then come up to the medium line of the pitchfork, which then gives you your next point of the harmonic. Let's say that's it, CC 786. And then let's say the outer warning line of the pitchfork's at the 786. Well, then from that pitchfork, you have a Gartley harmonic. So yeah, the answer is yes. There you go. You have some other questions? That's 2 questions. Could you go over the best practices for entering the atom trade, having difficulty with good entries? Yes, and I'll just see what the other one was. Why does my standard pitchfork on TradingView not look anything like that? Maybe I've changed something. Oh yeah, I need to give you the levels as well. So we'll do atom, and then I'll also give you those levels. I forgot about it, sorry. So I'm not sure what the standard is, but basically this is the standard that I use. I can't remember what the standard is on TradingView. Basically just the medium line and the 1. Okay, and this is my Fibonacci one. I won't always use the 2, but this is by standard. And for the pitch fan, this is also what I use. I can't remember what it looks like by standard, but yeah, that's what I use. For the let me know. This is the really annoying thing that I've just deleted everything on the atom chart. This is why I need to be more careful when I just press the delete button. I don't know. I done it. I just don't know why I do it, but I just accidentally delete everything at times. It is annoying, but nevertheless, there was something along those lines. We had something like this. We had the value area low here, and we were looking up for the point of control and the value area high. So basically, what would we be looking at for an entry trigger? we're going to be wanting, I think you could say there's two ways that you could start to look for an entry trigger. One would be that you do this. This is where I'm pretty good at foreseeing things, or just ideas, I guess. I would say that you could see this. And then you can get in much earlier, because as you start coming up for here, you can envision, okay, here's a symmetrical triangle, we're going to break out. Okay, the other idea that you could have going on here is that it does and triangles on altcoins are really good. The other idea is that you could have this, and then you could get an entry trigger that's a little bit lower, 2 high lows back, looking for, can't remember where the target is, but we know it's up there somewhere. And so that's another entry trigger that you could get. But let's say you want to play the aggressive trader, which is buying a breakout. Well, then you either market buy as soon as it comes above, and you just literally enter at market, or you try and get in with limit orders. I generally use more market orders when it comes to alts, because, well, that's a lie, actually. That is a lie. I don't generally just use market orders, but this isn't a scenario where a market order is acceptable, because you've got all the entry triggers needed. I would always try and prefer to buy lower. So I guess I prefer in a scenario where you can maybe get a pullback for a symmetrical or an ascending triangle. I generally don't want to buy a breakout with a market order, but that's obviously an acceptable trade. I would really have liked it to come up during the stream, because then you could have seen, or I would have commented. I don't really trade Binance anymore, so I couldn't have actually done it on stream, but I could have taught you through what I'd have done if this was Bitcoin. But nevertheless, yeah, all I'd be looking for is a break of the high, and yeah, either looking to get in on market if the volume's good. So this is where you're looking at the volume. If the volume's good, just get in a market, just get get in a market sort of thing. And you got your entry trigger, you got your end validation, you got your stop loss, and you got your target. And so, you just got to take the trade sometimes. If you start overthinking it, if you start debating it, you're going to have a good trade and you're going to miss it. Or, so you just got to take the trade when it comes. But yeah, those are the few entry triggers I'd say. Triangle, breakout. It kind of sucks that I deleted everything else, but that's the overall that we're envisioning here. If this was Bitcoin, I'd be much prefer to play the limit order, because you generally get those moves back below the level, but with altcoins it don't happen as much, so you got to play more at market with the altcoins. Yeah, there you go. So yeah, I hope that you've enjoyed tonight's live stream. I will end with the summary that we do have in here. So the summary obviously is the midpoint is a critical level for the trade that offers you a support resistance level. If you reject off the level, you trade back down to the warning line. If you get through the level, trade up to the the higher warning line. If it's a really high term time frame, each of those Fibonacci levels throughout the way are good levels of confluence. Obviously, the pitch fan is a layer of the Fibonacci time. The speed fan, go back to refer to the speed fan video if you haven't already, and used together for confluence. So you can use the pitch fan and the pitchfork together for some pretty epic confluence, which you could have a strategy just off of these two tools sort of thing. Gives you everything you need for a trade. I wouldn't do that, but you can. So yeah, that's tonight's stream on the Pitchforks pitch fans. That is the end of the Pitchfork series. I'll catch you in the Champions live stream on Sunday, and I hope you have a brilliant week in between. So thank you, everybody, very much indeed. Hope you've enjoyed. And I'll catch you on Sunday for the Champions live stream. Cheers, everybody. Thank you and goodbye. Cheers.